In the previous session, we had spoken about the objectives of finance, and we saw there are two major objectives. One is profit maximization, and the other is wealth maximization. We saw that in profit maximization, what happens is we would be focusing on increasing the profit. The profit can be increased either by maximizing the output or minimizing the cost. Then you have the wealth maximization. In wealth maximization, what happens is you would be focusing on increasing the shareholders' wealth. Okay, so these are the two major areas where we would be going about with the increase of the shareholders' wealth. So here we will be focusing in this session, we will be focusing on understanding these two concepts a little bit more in detail. We will be trying to understand what are the challenges, what are the advantages of profit maximization, what are the challenges that we have with profit maximization, similarly for wealth maximization. Now let's move on. Um, we spoke about profit maximization. So we all know that the objective of any business is to earn profit. Any business functions with the sole objective of creating profit. Okay, so that is the primary objective behind any business to go about with the function, with the function of any function of the function of any business is to go about with the to generate profit. Okay, so that is the objective. Now what we will be focusing on here is that we will be trying to understand when the management of a firm focuses on profit maximization, what exactly are they? So here, the management would be, the thrust of the management would be to increase this earning. Okay, the thrust of the management would be to increase this thing. So they would try and explore all possible means in terms of generating this aspect, that is, increasing the profit. So if you think about aspects such as contract manufacturing, or if you think about aspects such as outsourcing, and outsourcing itself, you have offshore outsourcing, all those aspects have come into picture because the sole objective is to maximize the profit. So what happens over here is they're trying to see what are the possible means by which the firm can increase their profit. So why would a firm go for outsourcing? So instead of the firm trying to build its own internal capacities in terms of carrying out back office activities, why don't we have the entire thing outsourced over to someone else? So that is the objective behind outsourcing. Then you have contract manufacturing. So instead of you trying to establish the manufacturing facilities, you try and explore and you try and outsource it to someone else. So for example, Apple, which is a California-based company, does not have any manufacturing facility of its own. All that they do is they focus on research and development, and they would focus on the administration. Foxconn, which is a Korean-based company, which has got most of its facilities out of China, is one of the it is the sole manufacturer for Apple. So what happens over there is that the designs of the Apple iPhone would be shared by Apple Computers to the contract manufacturer, who's Foxconn in this case, and they would be building the product for the company, or they would be manufacturing the product for the company. So that's what happens in contract manufacturing. Now, why is Apple doing so? Apple is doing so is because instead of Apple trying to create a manufacturing facility of their own, it would be rather economical for them to depend on an external company to come into picture and then take care and then look into the manufacturing aspect. So these are some of the means by which a company can go about by improving or increasing their profit, but at the same time they will try and maximize the output. So these are some strategies that the business would. We have the concept of outsourcing. Another concept of outsourcing is whenever you focus on any activity of a firm, it can be broadly classified into two. You have what is called as core competency, and then you have what is called as back office activities. So if you look at any firm, they would have a set of activities which would make up their core competency, and they would have a set of activities which would make up their back office activity. So the focus of the firm would be by focusing only on the core activities, core competencies, the firm would be able to maximize, or they would be able to leverage on its output. So that is what is meant by core competency. So whatever activity that does not come under their core competency, that in turn would be outsourced. They would try and find a suitable player, and the player would be responsible for managing that activity for the firm. So this is exactly the reason why, when it comes to your back office activities of running call centers, responding to emails, providing technical support, all these aspects would not be managed directly by the company. Instead, it would get outsourced to someone else. So what is the objective behind this? The objective behind this is that instead of the core company trying to focus on these activities, they would be trying to find out other players who would be managing and who would be running this show. Okay, so that is whenever a firm sticks to profit maximization, what would happen is they would try and identify all possible means by which they can go about with the maximization of their profit. They would try and explore all possible means to improve the profit. So it could be a number of factors. This could be by providing, a VRS, voluntary retirement or it could be n number of aspects which would be coming into picture. Okay, so that's what happens in profit maximization. Now, here the performance of a firm, the efficiency of a firm in the case of profit maximization, you would be measuring in terms of the profit that is generated by the company. So the evaluation of whether the company is functioning smoothly or not is carried out with the help of by measuring their profit. So if a company is able to generate good amount of profit, they are said to be a very good firm. If the company is not generating so much of profit, then it is not such a good firm. Okay, so that is how perceptions have been built up. That is how perception will be built up, and that is how the firms will be evaluated in terms of their efficiency and in terms of their function. Okay, so that's what happens in profit maximization. Now, when the focus is on maximizing the profit as well, you have to also remember that the business is subject to a number of risks, and the business may not be in favor of engaging into some kind of activities where the business is put into a very unfavorable or inconvenient situation. So the sole purpose over here is to try and maximize the profit. Now let's talk about some of the limitations of profit maximization. Some of the limitations of profit maximization would be that they would be ignoring the time value of money. So you have to remember the value of money changes with time. How 100 rupees would be costing today would not be how 100 rupees would be costing tomorrow. So the difference, the changes in the value of money with time is what is referred to as time value of money. Now, when the company focuses on when focuses on profit maximization, another major challenge that you are likely to face is that you will be facing the challenge of over exploitation of resources. Okay, here you will not be interested in understanding, are your resources being effectively utilized? You will not be interested in understanding, are your employees being overworked? Are you are you stripping down the resources of a place from where you are extracting it? So those kind of aspects would never be evaluated when you would go in for profit maximization. Another thing is, sometimes what happens is, when you become too aggressive in terms of generating the profit, you will end up ignoring the possible risks which are associated with that with those transactions that you're carrying out. Okay, so sometimes what happens is you would not be really focusing on the kind of risks that you're subjected to. So these are some limitations of profit maximization. The next objective of finance is wealth maximization. Let's discuss in detail what is meant by wealth maximization. Wealth maximization is another objective that can be pursued by the management, and here this is also known as value maximization. What happens over here is that you are focusing not on monetary returns, but you're focusing on creating benefits for your stakeholders. So there could be different stakeholders who are involved in your business. You could have government, you could have employees, you could have staff, you could have customers, So here the objective is not in terms of generating money. Here the objective is terms of creating a value proposition. So if you notice, there are some firms which would be focusing on certain aspects. They are immaterial. They are not focusing on generating money. Here the focus would be on creating value propositions for the value proposition for the stakeholders who are involved. Okay, so that's what happens in the case of in the case of wealth maximization. So here's an example. I remember interacting with a friend of mine, and he happens to work in Tally. He was working in Tally, and then he was sharing his experience interacting with the founder, Sham Guneka. So the company got into there was some so they have a he's Mr. Sham Goneka. He's a man who strongly imbibed with in terms of values, and it so happened that the company ended up selling some Tally licenses to a certain organization, and it so happened that there was a small mistake in due diligence process, and the company ended up overbilling them. Okay, so many licenses were not actually required. So when this came to the notice of Mr. Shah Guneka, what he did was he refunded the excess money. He said, no, we are not in here for the money. We are in here to create a value proposition for our stakeholders. So that's what happens when it comes to when it goes to wealth maximization. So the focus or the thrust is not the thrust may not uh, is on creating profit. So these are the kind of challenges that you may face in the terms of wealth maximization. So here the focus is in terms of creating a value proposition to the stakeholders who are involved in the business. So here this would be more of a very careful approach that you would be following when it comes to managing your activities. When it comes to managing the firm's activities, you would be focusing on a very careful approach. Now let's talk about the limitations. So it's wealth when it comes to wealth maximization, it becomes very difficult for us to define what truly is wealth. Okay, and how do you create that value proposition for your stakeholder? And then sometimes what happens is you would have n number of stakeholders who are involved or who are part of your business, and you may not be able to focus on all those stakeholders. So creating and defining what is a value proposition for your stakeholder may be quite difficult. And many a times what could happen is there could be serious conflicts between the owners and the managers. The owners may be imbibed on something, the managers may be imbibed on something else. So it could result, or this could create a lot of conflicts. So one such example would be what happened in the case of Cyrus Mistry and Ratan Tata. When there was a change in guard, when there's a change of guard at Tata and Sons, the the focus of both these people were entirely different. Ratan Tata, who was a seasoned man, his focus was on values, his focus was on value proposition. Whereas Cyrus Mistry, who was an external participant, and for him, what happens is that his thrust was somewhere else. So there was a conflict. And sometimes what happens is these conflicts could affect your organization on a whole, and it may not be a very healthy situation for everyone who are participating in the organization. Now, moving on, let's talk about the organization of finance in a firm. Now, when it comes to organization of finance in a business, what happens is this is more or less the hierarchy or the structure that would be followed. You would have the shareholders. Shareholders are people who own the business, and from majority of the shareholders, you would have the board of directors who would be formed. The board of directors would be led by a chairman, and sometimes what happens is, in order to manage the day-to-day activities of a firm, you would be having a CEO, Chief Executive Officer. In certain cases, in certain firms, the CEO and the chairman of the board of directors could be the same person, but it is not necessary in the case of in the case of all companies. So there are certain companies where this may be an exception. So for example, ICICI. So when in ICICI, when Chanda Kochar was leading the firm, she was the chairman as well as the CEO of the company. So she was playing playing a dual role. So in certain cases, what can happen is you could have separate people managing these profiles. In certain cases, you could have the same person who's managing these profiles. So that's what happens in the case of here. Then you would have the vice presidents, and the vice presidents, especially under vice president of finance, there would be two major profiles that the vice president of finance would be managing. One would be treasurer, the other would be the controller. Now let's look at in detail what are the differences between treasurer and controller. Controller. So there are two major profiles when it comes to finance, that you would be two different job roles that you would be finding in an organization when it comes to finance. One is the role of a treasurer. Now, treasurer is responsible for managing four major verticals: the vertical of cash, credit, banking, portfolio. So, treasurer responsible for cash management, responsible for credit management, banking management, and portfolio management. Then you want to have a profile which is called as a finance controller. Now, the finance controller is responsible for managing accounting, which is the statutory requirement, audit, budgeting, and taxation. So when you look at these two specific job roles, what happens is the treasurer is responsible for managing more or less the dynamic aspects of the firm. The controller is responsible for managing the statutory needs of the firm in terms of fulfilling the law and other compliance aspects. Now, it so happens that in certain companies, they may not have specific job roles for a treasurer and a controller. The finance manager will be duly following both the functionalities. He will be following the function of, he will be following the role of a treasurer. He would be following the role of a treasurer, controller. It is not necessary that they will be having separate profiles for managing these two aspects. It could be played by the same role, and it could be played by it could be played by different profiles. In certain companies, but especially more rigid, sorry, not rigid, that would be very inappropriate terms to use. Like in the case of certain firms which are quite large in size, what can happen is you could have these roles divided into separate individuals. So you could have an audit manager, you could have an accounts manager, you could have a budget manager. So depending on the complexity and the kind of activities that the firm is engaged into, these roles may be further divided. So these are the two major profiles that you will find in a firm which is closely associated with the financial aspect of a firm. Now, let's talk a little bit more about these roles. Like I said, in any firm, these may be separate, or these may be managed by the same person. Now, let's understand a little bit more in detail about the functions of a finance manager. So in this part of the session, we will be focusing on what are the specific functions that are paid by the finance manager. The finance manager is responsible for forecasting all the financial requirements of a firm. He would be forecasting the cash requirements of the firm. He would be forecasting the credit requirements of the firm. He would be responsible for preparing the budgets. He would be responsible for ensuring that these budgets are reviewed frequently. Any deviations, the appropriate corrective measures are taken. Root cause analysis is carried out. So the first functionality is to kind of understand what are the financial requirements of the firm. How much of money is needed? Where do you get the money from? Where exactly to spend the money? So these are the aspects that are taken care by the finance manager. Second role that he would be needed is he would be required to understand the capital requirements, and based on the capital requirements, where exactly can the money be derived from? Should we go for a loan? If you're going for a loan, should we go with bank A? Should we go with bank B? Or is there some other kind of source of finance that we could tap into? So these are the aspects when it comes to acquiring necessary capital. When it comes to investment decisions, here the financial manager is responsible for understanding where exactly should the money be channelized into. Okay, where exactly should the money be spent? Okay, so that is what is responsible, or that is what is taken care by investment decision. Then you have cash management. So as a part of cash management, what the finance manager does is the finance manager is responsible for budgeting and trying to understand what is the kind of money that is needed by the firm. Okay, what is the kind of money that is needed by the firm? So that is what is meant by cash management. Then the finance manager is also responsible for ensuring that the firm is looking into and trying to understand what is the kind of the maintaining adequate relationship between between the various departments of an organization. Okay, so he's responsible for liaising between the various departments. Should there be any needs? Should there be any situations where there has to be an interaction? So in such cases, what happens is the finance manager will come into picture, and then he will be responsible for liaising and then interacting with the people who are responsible, and that is what he would be doing when it comes to this particular role. So these are the five major roles that has to be played by the